What is up, YouTube, and welcome back to another Fridge Financials video. And what we have in today's video is a very interesting video. And as you will see, the portfolio is up over 6.5% on the day here. There's other things going on with the money that I have right now in this moment in time. We'll talk about that in another video. But we had a trade that I have been watching and managing for the last 2 weeks or so. And it's a trade that initially started with a cost basis of $112, and it almost 10x'd my return. I made over $1,000 with $112 for this trade here. So we're going to break down the idea, and it's a strategy that I now want to look at doing more moving forward here. So again, if you're excited for today's video and you're curious to know what's going on, always feel free to like the video, subscribe to the channel, and turn on those bell notifications for all future uploads. And if this content isn't engaging enough for you, I don't know what to tell you, because let me tell you, this strategy here, while it is advanced, and it did take a lot of time to look at the numbers and run the calculations here, it paid off, okay? Over $1,000 made here. And believe it or not, it's based on earnings. And let me tell you what it's going to look like here. So the earnings that we played for today was Nike. And as you can see, Nike had a phenomenal day after their earnings. Earnings call, they beat earnings, but they were low earnings compared to the year before. But the market loved the guidance. And that is what really matters here, is the forward guidance. The stock market tries to price earnings into the future, not the current value it's at right now. So they liked what they heard from the conference call, and then Nike shot up like a rocket. And let me explain to you how this trade worked. Now, the strategy here started off with what's called a double calendar strategy. Okay, you might have heard of a calendar play here. It is an advanced options trading strategy, which I will have a different video that covers more in depth into it. But basically what the idea behind a calendar is, and I'll show you how it works here, is say you go to trade Nike options. You want to go, say, I don't know, like a month out, for example, here. You're saying, Fridge, actually, we'll go longer than that. This is a little bit of an introduction. We'll do a better video about it later on. Just kind of give you a little bit of insight here. But say by the end of the year, you're bullish on Nike. Things going to go to $75 here by the end of the year. It's at 72 right now, so it's going to go a little bit up as a result. So you'd buy this option here. But short term, you think the market's not going to move much. There's going to be a little bit less volatility. And in order to offset what you're paying, because again, when you're buying the option, you're paying for it, you might want to sell a shorter dated option here. Same strike price, but just sell a shorter dated one. So maybe I want to go 30 days out here, for example. And I'm still going to be looking at the $75 strike price here. And it creates what's called a long calendar spread. Because what happens here is that if Nike stock increases in value, the bought option becomes worth more, and the sold option also loses value while this one gains value here. And your max profit is like this mountain peak right here at 75 exactly, which you never will expect to get this. Usually you can close a little bit earlier, or maybe over here, even closing on the backside over here. But again, as the stock moves higher, this call becomes worth more, this option becomes worth less, and you get the difference is what's being calculated here. And if it comes down, at least the sold option here is going to offset your bought option here. So instead of paying $605 and losing all $605, you actually only lose $474 because they give you the premium for this option right here, which gives you that nice little offsetting value. And this is called a long call calendar spread. And it's a call calendar spread here. Now, on the other side, it's very, very similar, but you do the same thing for a put option. So say you want to go December 19th. Say you think, okay, Nike shouldn't have gone up that much. I'm going to buy the 65 put here. But short term, maybe it won't move as much. You want to do the same kind of idea. You go to August 1st. And then instead of buying the put option here, you would sell the 65 put here. And it creates a put calendar spread here. So you do on the call sides, you do on the put sides, and basically, again, the sold option is what offsets your cost basis for the bought options that you have here. And the idea is to have the shorter ones expire faster, so they get more premium, and then the bought ones keep more value. The reason why the bought ones keep more of their value is because it's a longer time frame, and because there's not as much theta decay. again, the faster it comes up, the more I lose value here. But if you're looking at, 5-6 months here for this option here, there's not going to be much movement in this price right here, but there'll be a lot more here in 30 days. The stock's going to have a lot more movement in terms of option prices within 30 days compared to, say, 5 months. So that's kind of what the goal is here. Then if this expires worth is right here, it's amazing because what happens, you could then do another one in September and then October and kind of offset it that way as a result. You might have heard it as, if you do the call option, it's called a poor man's covered call, essentially. It's a whole different thing there. We'll talk about that in a different video as well. But that's the idea. Now, a double calendar is, and I have images here to back it up. This is an example of a double calendar spread here, as you'll see right here, double calendar. What it is that we're doing the same thing here, but we're playing on earnings, because earnings are the 26th, and this is the 27th, and the bought options are the week out afterwards. So again, pushing back that extra week gives me time to have these bought options still keep a majority of the value. Not a majority, but still keep a decent amount of the value still compared to the sold short leg options, because these are expiring today. On time I'm recording this, these would have expired next week. So I still have a whole week for the options to play out however they want to play out. And what you'll see is it creates this double calendar here. Again, here's the put side calendar, here's the call side calendar, and here's what it creates as a result. Now, when I screenshotted this in Discord at the Kingdom, shout out to the Kingdom as always. When I screenshotted this here, it was worth $26.50. I bought mine at $28 for every contract. So let me show you what it looks like. And then we're going to break down into how I turned this into over $1,000 here, okay? So let's go all the way down here. Here we go. So let's go to the history here. Let's break it down here. So here's the 4 option I opened up here. So you take a look and see. So this is me paying $112 plus 64 cents because, again, for the contracts. I bought 4 contracts here. $28 for each one. Again, it's 28 cents for every share, and it's 100 shares per contract. So it's $28 per contract, 4 contracts, $112 plus fees. And as you can see here, here is my options I have here. Again, filled on the 13th, right before market close, which was 2 weeks ago. So literally going right at the end of market close on a Friday. And we have a sold Nike 68 strike price call option for the 27th. We have a bought option for the same strike price, but a week farther out. Just like this image shows right here. Here's the sold one. Here's the bought one. And on the flip side, same thing. 55 I sold, 55 I bought, 27th and the 3rd. And again, you can see that right here as well as a result. It's almost kind of like the Iron Condor, which is an old different video that you'll have to watch that I'll put out also for you. Where basically you're selling options on either side to make sure it kind of stays within that one. But you're also buying call options and put options to basically create what's called the strangle, right? I made a video about that yesterday. Feel free to watch it. At the time of recording this, it's almost like a combination of an Iron Condor for the short legs, where you're hoping that doesn't move, and then the strangle is hoping for a huge movement here. It's kind of what you're doing. It's a little bit of a weird strategy that we're doing here. So that's what's going on. Let's break down the numbers though, okay? So again, initial cost basis, $112.64. Those dang regulatory fees, let me tell you. What you'll see here yesterday, the time I'm recording this, June 26th, before market close, because again, with earnings being after hours, if Nike has a huge move and these sold options are in the money, you might be forced to you might get early assignment, which you don't want. So the thing is, this is a strategy that can be very, very risky if you don't know how to manage and close positions accordingly. If I didn't close these out before earnings, I would have 100% been early assigned on the Nike 68 calls, because now they're in the money. People would have gotten an early assignment on that one. I can promise you that one, because it shot up so much. So I closed these while I couldn't be assigned. I closed these for profits. You can take a look at the profit breakdown here. Or maybe it won't tell you here, but let me tell you. So I can break down the numbers here for you. I can put, actually I have screenshots in Discord here. So what I'll do is I'll put some screenshots up here as a result, because just to give you guys the full transparency of the video here, so you guys know exactly what I'm looking at here. So for the bought Nike 68 call option here, this one, I made a profit of $92. Okay, this one costed me $92 right here when I closed it, or I had to pay $204, but the return was $92 because theta decay had this call option lose value. For the put option I closed, again, this is me closing the short legs here. Again, these are the short legs, 27th, 27th. I'm closing these ones. When you sell to open, you buy to close. I bought these ones back and I made a profit of $240 on the Nike puts here. So these two options together combined was $240 and $92, which gave me a breakdown of $332 for closing the short positions. Now, why did I close these short positions and not let it ride out? Again, I closed these because I made some profit on it because they were losing value, but I also didn't want the risk of being assigned if Nike moves in a huge direction, which it did. So thankfully I did this as a result. So I closed these two out. I had made $332 profit. I paid $112 here. So before Nike earnings, I was up $220. Now, what happened as a result of it was that when I closed out these two legs, I still had two legs left over. I had the bought ones. So if you take a look here, these two right here, these short ones I closed out, I still had a long strangle here being played out that was going to expire next week. Anything in fridge, why would you do that? Well, there is risk to it. And here's how I broke down the math yesterday before market close to make sure I was monitoring the trade carefully here. This was a simulation from Options Profit Calculator that I used, and I boxed in basically where is my loss going to happen, right? Because the 27th is right here. So here's the 27th, which is today's day at the time of recording this. Again, currently speaking, I have made $220. Currently speaking with the math I did. And I showed you on the Robinhood. Here's what could have happened. If Nike went to 65, I basically would break even on this is the strangle here. This is all that's left over. This is a strangle option here. I put the strangle in the calculator with my cost basis. If Nike opened at 65 today, I would have basically broke even on my trade. Because I made $220 on the options I closed, I would have lost $220 on the strangle. I break even. Anything after that, around 65, is a loss on the strangle, but still a profit overall. So I made $220 on the short legs. I would have lost 88 here. I still would have made, $100 and I don't know what it is, like a little over $100 here. And on the opposite side, same thing. Anything below 58, I make profit. 57 is a very small profit here. Again, $208 loss on the strangle, made $220 on the short legs. I would have made $12 here, but still profit. $12 starting off with 112 is not even that bad of a return. It's almost like 10%. So I boxed in this and I looked at this and I said, okay, here's where the options are telling me. And I mapped it out on my Webull as well. Nike's expected moves, the implied volatility, the expected movement of Nike at earnings about 2 weeks ago was about 8 to 9%. So I'm looking at this box here, I'm thinking, wow, this has a pretty good chance of moving. Again, as long as Nike doesn't get volatility crush, implied volatility crush, where it does not move and it's stagnant the entire time. As long as Nike doesn't get hit with a average earnings and no guidance or whatever, and it stays flat, I still have a chance to make some money. And even if it didn't move, my max loss on this strangle, I was going to close today no matter what. I was going to close at 220 at the 27th. I wasn't going to let it go all the way out here. But on the 27th here, I would have been down $452. I made $220. I'd be down about $300. So, obviously it's a risk you're willing to take with a gamble here in this case, but you're basically expecting that Nike just won't move or won't move enough. So that's kind of what the play was I was looking at here, right? And so I was running the numbers here and I was watching after hours and I was mapping it out here to take a look at what's going on here. So take a look. Okay, here's my Webull. I broke it down. Here's my basically break even. 64.58 are my basically break even prices right here. Here's my large loss if it stays basically neutral. And then profit is anything up here and anything down here. And oh boy, did we hit some profit. I got so nervous right here. Not really nervous. I was more like, oh, okay, well, this is a kind of a bust here. And then the conference call comes. They mention some positivities about future guidance, stuff like that. And boom, takes off. And I'm sitting here like, dude, I just made a killing. on it. And the options rose even more right at market open. I sold around here. I could have gotten a little bit more out of it, but obviously I don't care. I'm taking my profits if it's $1,000 on $100 buy-in to start off with. And I made a crap ton of money on it. And if you take a look at the results here, here's me selling my Nike one here. This is me selling my calls at market open this morning, about 10 in the morning. I was at work, believe it or not. I was doing like some summer training stuff. And I sold them at 10 o'clock while we had a break. And this option here, I made $1,276 here. These are still open. And what you'll see at the Nike strikes here, or what you'll see at the Nike over here, is that this is going to be a factored in loss of $480 because it's going to be worthless because obviously it would pumped up so much higher. But the good thing is with an earnings play like this is that Nike just needed to move. I needed Nike to move in some way. Have a movement, Nike. Don't just get implied volatility crushed. So the thing is that I was banking on here was I closed the shorts early for risk of early assignment. I took those profits to offset my strangled price I paid for. And on top of that, then I was able to say, just move in a certain direction, Nike, and we are golden. It could have sold off 10%. I would have made money on the put side either way. But it moved on the call side. I made a lot of money on it. And I could not be happier with my overall profit, which is where this trade happened. Again, you can see the big, boop, nice jump at market open, over $1,000 profit here, and I was able to close it out. So I started off with a cost basis of $112. I closed the shorts before earnings, and then I closed the strangle right after earnings, and I made a lot of money. Now, things to keep in mind about with this idea here, and there is more risk. Remember, my cost basis was $112. That was the max loss when I first opened the trade. With me closing the short legs early, that increased my maximum loss. I was going to close on the 27th no matter what. I was going to do it no matter what. But as you can see, it increased my max loss to being over $300 instead of only $100. So it's things to keep in mind about where if you want to close legs early, it's not a bad play. It worked out well for me here. But you got to keep in mind that you closing legs out early gives you a chance of having more of a loss than what you bought in with. I bought in with 112. I could have lost 452 here. And I made, whatever it was, 220. I would have been down again, like 230, 250 bucks here if it just didn't move as much as I was hoping it would move to. So that's the thing to keep in mind about. So keep that in mind if you're doing this kind of strategy here. Again, I'm going to do a lot more testing with the strategy here, playing earnings on major traded companies to see how this plays out here. And what you will notice is why I close it out so quick. Because if I let it go, even till next week, look at the value, look at the decaying happening right here. This is the weekend. 28, 29 is the weekend. So we're looking at the 27th. Say I was at max of 452. Saturday, I lost $100. Sunday, another $80. Monday opens up, I'm down $250 more than what I started with right here. So that's why I played it to close before a weekend, before theta decay kicked in. And like I said, let me tell you, it worked out so nicely, and I'm running it again. What's the running on it with now? Delta Airlines. Delta Airlines has earnings coming up 2 weeks. And what you'll notice, strike prices for before the 11th, 3 puts here, 3 calls here, and then bought once for the week afterwards. This one cost me $105 to start the position with. But again, if I close these short options earlier, then my max loss could be a lot bigger as a result. And if you want to take a look at the simulation here, take a look at what happens as you do this kind of trade. Actually, we can just do it this way. Let me just do it on here itself. It's a lot easier that way. I'll show you how to open one up so that you guys see what I'm doing here. So I did a July 11th. So again, looking about 2 weeks out here. They're earnings on the 10th before market opens. So I'm going to be closing these on the 9th before market closes, most likely, the sold options. So I sold 3 of them here. This is my high side. I then sold 3 of them down here, which is my low side. And it creates this nice little, basically, hey, don't trade between these two. Trade between here and here. It's a 12% move downside, 13% move upside, technically 10% and 9%. And believe it or not, the earnings for Delta Airlines are about 8% expected movements right now. So this is right outside of that. So hopefully you can get that maximum premium that we get as a result. Then what you would do is you go a week out afterwards and you buy the options at the same strike. So I'm going to buy the 45, I'm going to buy the 55, and this is what the map looks like. This is what your image will see right here. So again, as time goes on, you get more and more premium juiced up here, and the return is actually crazy potentially. You'll never get this. It's never going to get 55 on the dot. That's very, very unlikely to happen. Or 45 on the dot. It might be like 45 and some change. But taking a look at what's going on here is that even though each of these contracts cost me about $33, and the returns are pretty, the max profit is pretty good. You're looking at almost 4xing your money here, and that's without you closing positions early. So my focus is going to be to watch Delta Airlines between now and the next 2 weeks out and see how it moves. If it moves higher, okay, I'm going to see if it gets into the money for either of these strike prices here. I might just close it for a loss. But the hope here is to make sure it stays between 45 and 55, close out the two short options right here, and then hopefully make the strangle, get a big movement either direction. Boom, Delta Airlines takes off in some direction, no pun intended, and we can maximize some profit again. So I'm going to try it out again. I'm going to roll the strategy out here, and I'm going to see how it goes. So yeah, that is literally what happened in the market today. Absolutely wild. Again, I know it's a longer video. Hopefully these images make some sense to you here. Again, basically you're playing two sides of the play here. It's almost like an iron condor and a strangle basically just come together and create this basically like region that you can work with and see where you get those maximum potentials that you get as a result. It's a double calendar strategy you can look at here. And again, knowing what your risk tolerance is, again, this was a lot of research and charting and looking at things about like, okay, what can I expect to have happen? It was an unbelievable day in the market for me. I'm very, very grateful. I'm not here to brag about it, but I will say this strategy, I'm going to hopefully trade it more and just kind of see how it goes. I'm going to keep track of my results here so you guys get a good image of it. Again, if you've made it far in the video though, and you love this kind of content, because this is some crazy content here, feel free to like the video as always, and make sure you subscribe to the channel. We're almost at 900 subscribers at the time of recording this. The big 1K is so close, and I'm super grateful for each and every single one of you. We hope you're making money in the market, even if it's not some crazy play like this. And as always, I will see you guys in the next video.